Today was a devastating day on Wall Street as we saw some of the worst losses in a couple of years. The Nasdaq Composite was down 5% here today. We saw the Dow Jones give up 1,000 points. We saw only 4% of the stocks in the S&P 500 close higher today. So it was a washout of epic proportions today, especially considering yesterday's big up move after the interest rate hike. So we'll talk about all that and see what it means for our posture in tonight's video. And then we're going to get into a trade application example where I want to share an idea with you that has only happened once before this week in the last 520 weeks. It had only happened one other time. So if you're interested in that, make sure you see tonight's full video. Let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's May 5th, 2022. Happy Cinco de Mayo to everybody. I imagine that there's going to be a few more tequila shots here imbibed later on this evening by traders after today's carnage in the markets. If you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below and make sure you sign up for our email distribution list, which you'll find in the description area. In addition to that, we're heavy users of Twitter. My handle is @BrandonVanZ. And if you're not doing so already, I would encourage you to follow me. We also appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence over on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's jump into today's trade activity. And my, oh my, this was one for the ages. This is a day where the Nasdaq was down 5% in a single day. Now, that's one of the bigger meltdowns that we've seen in quite some time. In fact, we'd have to go back a couple of years since we saw a single day where we were down that much on the Nasdaq Composite. But it's also important to take a deep breath and remind ourselves there are worse things. If you had $1 and you took 5 cents away, you still have 95 cents left. Now, of course, the Nasdaq's been in a little bit of a free fall for a while since then, so that may not be the perfect analogy. But I do recall working for a money manager back in my days in San Diego. This was back in the 2003 to 2005 time period, somewhere in there. Anyway, I recall asking my boss at that time if he was trading during the epic 20% plus meltdown of 1987, and that was in a single session. And indeed he was. And I asked him, what was it like that day? Because I was a curious 20-something-year-old at that time. And he said, you know what was interesting about it is that while it felt like it was just an epic sell-off to him and his associates at that time, he remembers just looking out the window and watching the people pass by on the street having not a care in the world, as though they had no idea that the stock market was falling 20% in a single day. And this afternoon, I kind of thought about that again as I was walking my dog. And, I looked around, other people were walking their dogs, and I'm sure they had no idea that the Nasdaq was down 5% today. So it is important to kind of take a deep breath and remind ourselves that, yes, these days are terrible. They hurt. They're painful. In the end, it is just money. It could be worse. And we do have a belief that the stock market will go up over the long term, and it's days like this where we have to kind of earn our keep. And again, not fun, but days where we can learn from, and as long as we're not willing to put our head in the sand like an ostrich, we will remember days like this and hopefully get better after days like this, and hopefully position size better and offer ourselves better risk management and all those good types of things that come with these learning experiences that life hands out to us. So with that out of the way, let's take a look at the ugliness that was Cinco de Mayo 2022. And it was red across the board. Maybe red hot peppers there, not a whole lot of green avocados, but there's a few little patches of green here and there. I did notice a couple of dividend aristocrats were up today, AbbVie being one of them, not by much, but it was up 0.39%. I also noticed that one of the other dividend aristocrats that we have a long history with in my classes, not only do we own it in one of our dividend portfolios from several years ago, but we also own it as a coffee can stock in one of our top-down trend trading classes that I teach here at Market Scholars, and that is Albemarle. Some of you might not be familiar with that company as it's not that well known, but it is big enough to be in the S&P 500 with a $27 billion market cap. And Albemarle is a lithium miner, and it was up 10% today. Of course, with electric vehicles being all the rage in recent years, there's been a heightened interest in lithium mining, and that has benefited a stock like Albemarle tremendously over that time period. So a couple of bright spots there, but as you can see, it was pretty bleak. There just wasn't a lot. There was not one single sector where it felt like, oh, hey, if you were just hanging out in that sector, you would have done fine today. Even the energy stocks fell for the most part. A couple of them up. Pioneer was up, and also Occidental. But otherwise, the rest of the oil stocks were pretty much down today as well. You had Twitter that was up today, but of course it's going through kind of its own unique circumstance right now as news emerged about how Elon Musk had planned on financing his expected purchase of Twitter, the whole company, later on this year. You did see Kellogg, as an old school food company, come through with a nice day, up 3.5%. But, you can see that, there was Becton Dickinson. That was another dividend aristocrat that managed to be up here today. So it's good to see at least 3 aristocrats closing in the green. But, everything else is pretty much in the red. And it was a wholesale washout. We'll take a look at the specific numbers here in just a moment. But I've already done the calculations, and today we saw 96% of the stocks in the S&P 500 close in the red. That is how terrible it was today. So even if you manage to have 1 or 2 stocks in the green, you're probably doing a little bit better than the average person out there. I have no doubt that there were some people that ended up with a complete wipeout here today with all of their stocks lower. And you can see why. I mean, if you look at the tech space, the Apple and Microsoft areas, of course, capturing a lot of investor interest because those are the biggest market caps and therefore they have the biggest influence on the S&P 500. And by the way, David had a great post on Twitter here today talking about Apple and how it's held up reasonably well. And if it were to fall into more of a corrective bear market territory like a lot of other stocks, what that could mean for the overall markets. But even today, they were taking out the best and the brightest and taking them back behind the barn and shooting them, as the old saying goes. So AAPL was down 5.57% today. Microsoft was down 4% today. NVIDIA, one of the bigger players in recent years in the semiconductor space. It's now nearly a $500 billion company. It was down 7% here today. And then let's talk about the 2 big consumer discretionary stocks off to the right-hand side here. Amazon got pulverized yet again, down 7% here today. Remember, last week it was down tremendously after its earnings and spilled over yet again here today. And then Tesla has just been in the house of pain ever since Elon Musk has launched his bid to buy Twitter, as there is fear that Tesla shares could be sold or at least, called into the financing of his Twitter deal. And so Tesla was down another 8% today. It is very rare, by the way, to see Tesla down 8% on the same day that Albemarle is up 10%. Usually those two trade with one another, but today was a rare day where that just simply wasn't the case. So when you've got your biggest players, and by the way, Google was down 4%, Facebook / Meta was down 7% today. So those are our big kind of Fang types of companies out there. When they are down, good luck. The whole market is going to have a very hard time staying in the green if those biggest players are down, and they were not just down a little bit, they were mostly down significantly today. These were not just afterthought types of days. These were like 5, 6, 7, 8% meltdowns with some of the biggest companies on the planet, some of them being trillion-dollar market cap companies. This was a very unique day throughout time. So enough with the mess that we see in front of us here with the heat map. There's just not a whole lot to get excited about here. So instead, let's go ahead and take a look at another part of the platform and get a sense of the true numbers of what we just looked at a second ago by looking at the Market Watch Visualize area here and pulling up the S&P 500. And you can see that today there were only 19 stocks in the S&P 500 that managed to close in the green. 479 closed in the red. And so if you work the math out there, you're talking about only 4% of the market that managed to close in the green here today. And 96% of the market, if you're using the S&P 500 as your proxy, closed lower today. That is a washout day. And of course, what makes this so devastating to a lot of people psychologically is recognizing that we just had an epic up day yesterday. Of course, Jerome Powell coming out and raising interest rates 50 basis points, and then the market really taking off once he announced that they would not consider a 75 basis point increase at the next meeting. So to have all that enthusiasm just yesterday completely washed away today and then some it really does a number on investor psychology. So this remains a more bearish market environment. And remember when I was with you on Tuesday, that was already the case. And on that particular video just 2 days ago, I did a somewhat rare bearish trade, right? Because I've been doing a lot more of those sold put trades recently. But on Tuesday, I chose to do a bear call spread. And yesterday, I felt like a fool for a part of the day. But here, just 2 days later, I do then recognize why there is value to having the balance on the other side of your portfolio and actually having some bearish trades working to your benefit. So that, bear call spread on Texas Instruments did help us to a degree here today. So it's been an amazing 48 hours that we have recognized as traders and investors, where we had an epic move to the upside, followed by one of the biggest moves to the downside we've seen in years. And so when you combine those two things together, it is incredibly rare. You probably have only seen that type of behavior back-to-back days on just a handful of times throughout history. That is how rare what we have just recognized is. Let's go ahead and come on over here to the charts now. And I like to pull up this chart 6D for those of you that are premium members of Market Scholars. Remember, you get access to all 50 of the custom charts that David and I build and use in our presentations and also in our trading rooms. We actually had a long conversation about chart 2A for those of you that are interested in my dividend stair-step chart. I got a question about that in my Q&A session here today. So if you are a premium member, I spent about an hour going through all the details of that particular chart. So if you've been curious about having kind of a tutorial style of how to interpret chart 2A, you'll want to watch today's question and answer session that I recorded there. But anyway, back to this chart 6D, I like to pull this up on days when we have at least a 1% move in either direction. And I was kind of joking with you guys here maybe a week or two ago, where I said, boy, I'm bringing this up quite a bit because it feels like the market is moving more than 1% every single day, and maybe I need to increase my hurdle rate there. Maybe we should only look at it when we're moving 2%. Well, today is one of those days where it would have just simply blew it out of the water, whatever my hurdle rate would have been, because as you can see here with the actually this is the Nasdaq Composite we're looking at. It was down 4.99%. So let's call it 5% just to round up there to a nice round number. So we had a 5% meltdown day. And so this is what that candle looks like, or that bar on this graph looks like. Not only did it go from this zero black line down to the 1% lower level at that blue line there, and not only did it go to the orange 2% lower level there, and not only did it go to the fuchsia 3% level there, but it would have gone through a 4% level had we actually shown a level there, right? It happens so rarely that it's usually not even worth putting on there. But we would have gone straight through the 4% level all the way down to close right at the 5% level today. And you can see, of course, the Volatility Index for the Nasdaq went up tremendously as well. It closed just a hair below the 40th percentile. So, it's kind of the Nasdaq's VIX is the way that you can think about that. But that is kind of one of the strange things that happened today. The VIX itself was not up all that much compared to what you would have traditionally expected, right? The VIX was up 5 points today, up to 31. But when we have these kind of wipeout days, you might have expected the VIX to just take off to really spectacular levels. So just as an example of that, let's pull up a 2-year chart on the VIX instead of a 1-year chart. And if we go back to this time period in June of 2020, notice that the VIX was all the way up here in the 40s. So, with us only being at 31 right now, it's almost a little surprising that the VIX wasn't up more on a day like today. Now that I've pulled up the 2-year 1-day candle chart here, so in other words, 2 years worth of time, each one of these candles representing 1 day, I want to go back to the Nasdaq Composite because I wanted to show you something that was quite interesting. Hang on a second. There we go. It's just dollar side comp if you want to pull it up on Thinkorswim. And I wanted to show you that this bar here today that stretches all the way down to basically a 5% move has not happened on the Nasdaq since going all the way back here to this particular bar. I had to pull up a 2-year chart because it has not happened in the last year. So I couldn't just use a 1-year chart here to show you how far back in time it's been since we've had a day like this. We haven't had a single day like this in the last year. It's been nearly 2 entire calendar years since we've had a day like this. And that last time we had it was June 11th of 2020. Remember, that was just after the whole coronavirus wipeout when there was still a lot of nerves in the air about what the future held. Remember, at that point, we didn't even have a vaccine yet. So we didn't know if the whole world was going to crumble. And we didn't know what it meant for the economy and for the stock market. So there was a lot more jitters back then compared to what we're dealing with now, at least in regards for the coronavirus, where we feel like we've largely got it under control to a degree, where we feel comfortable traveling and different things like that. But anyway, on that day, the Nasdaq was down 5.26%. So it wasn't all that much more than what we experienced here today. So that hopefully puts things into perspective. And also, the other thing I would add is that where we're at with volatility on the Nasdaq is a little bit more aggressive than what we've seen on the S&P 500. So down below here with this blue line, while we're still looking at the Nasdaq chart, this blue line will represent basically the volatility index of the Nasdaq, or at least the comp Q here. And you can see that where we ended here just a tiny bit below 40% is higher than any other move on this chart, because this has been a more aggressive move for Nasdaq related companies, right? This is a move being led lower right now by growth stocks, and the Apples and the Teslas and the Netflixes and all those companies are in the Nasdaq, right? A lot of them are in the S&P 500 as well, but they're more influential in the Nasdaq itself. So I thought that was kind of interesting to find that the Nasdaq is now getting blasted much more aggressively than what we've found otherwise. If we compared that to the S&P 500, you can see, oh, hang on, it's not $SPX, it's just regular SPX here. Here's what I was referencing before. If you're looking at the volatility index down below, notice that we are still today below some of those higher levels. Even just this year, here in March, we were higher. Back here in October of 2020, we were way higher. We were way up into the 40th percentile instead of in right around 31 where we're at currently. We're at 41 back here in October. And then back here when we had that big wipeout day that I referenced before for the Nasdaq, the S&P 500 also got wiped out that day. That was June 11th. And look at how much more vicious that selling on the S&P 500 was back on June 11th. We were down 5.89% on the S&P 500 that day. Today, the S&P 500 managed to get through this relatively easily in comparison to the Nasdaq because the S&P was only down 3.5%. So again, we were wiped out back there on June 11th in the overall S&P 500 compared to what we put up with today. And naturally, when you had that kind of a wipeout, the volatility index back then was in the 40s as well. So again, the S&P 500, while down significantly today, has been holding up a bit better than the Nasdaq. And I think that's largely because in the S&P 500, you've got a lot more energy stocks, you've got a lot more consumer staples stocks, utility stocks, whereas you don't tend to find those types of sectors, oil, utilities, staples, in the Nasdaq composite. not at the same degree that you find them in the S&P 500. So yes, it was terrible on the S&P 500 today, but it could have been worse. And all you have to do is look at the growth stock land within Nasdaq Composite to kind of recognize that. So I thought all of that was quite interesting. For the Nasdaq itself, we are at the highest volatility levels that we've seen in 2 full years, and it was actually the worst single day performance for the Nasdaq Composite in basically 2 years as well, whereas that wasn't quite the case for the S&P 500. In fact, the S&P 500, believe it or not, we were down more just here on April 28th. Right, if I go back here to help you see it a little bit better, because I know those lines are awfully thin, but if I just look at a 1-year chart here, the S&P 500 today, yeah, it was a wipeout, don't get me wrong, but we're actually down worse than what we saw today just here a week ago. You know, it's easy to kind of forget that. I was in Omaha, so it's a little bit easier for me. I was traveling, but, you know, we actually were down, 3.63%. On April 29th, just a week ago, and that was worse than what we experienced on the S&P 500 today. So it's been a wild ride, without a doubt. As I've kind of stated to you guys in prior presentations, our duty right now is just to stay alive, right? I've been doing a lot of those sold put trades, and a lot of you probably think they're quite wimpy trades, and I don't blame you if that's what your thoughts are. But, you know, I'm just trying to stay alive, right? We need to be able to survive these difficult times to enjoy whatever epic market rally occurs in the future, because I do believe that the stock market at some point in the future will hit an all-time high again. But if you blow up your account before then, you're not going to be around to enjoy whatever recovery happens at that time. So I've been doing a lot of those sold put trades in the last couple of months, which are bullish, but they're not aggressively bullish. They provide a lot of flexibility because I'm selling out of the money puts. And even after a wipeout like today, not a single one of those sold puts that I've had in the last couple of months are in the money. That's how much flexibility I provided myself up front. And it's not to say that they're going to be winning trades, because, you know, if we keep on getting 5% wipeout days, eventually they will go in the money. But right now, all of those bullish trades that I've been doing with you guys with the sold puts specifically, and there's like 8 of them, all of them are still in reasonably good shape despite the very terrible market conditions. So for those of you that have taken a different approach and have gotten aggressively bullish during this time where the stock market has been really ugly, you're probably having a slightly different experience than me. And if that's the case, that's okay, right? We all do things that we wish we could have done something different, right? That happens all the time. But if you're newer to these types of meltdown types of markets and you've been way too aggressively bullish, then use this as an opportunity to learn. Like I shared with you guys a few weeks back, when I first got started in the world of investing, it was in late 1999, early 2000. For those of you that are familiar with market history, you'll know that that was about the time when the whole .com bubble started to implode. That was the topping out period. So there is this tendency for the market to suck in a whole bunch of people that may not have been involved in the markets prior to that, because of all of the rosiness that is taking place and all the jubilation of upward trending markets, bringing in a new crop of investors and then cutting their heads off, right? And it's up to you to determine whether you're going to be a survivor or not, right? I have no doubt that there were a lot of people that placed their very first trades the exact same day that I placed my first trades back during the dot-com bubble, that eventually got flushed out of the system and they swore the stock market off for life, and they haven't been back. And you know what? That's been a bad decision on their part, because of course the stock market has gone on to all-time highs tremendously since those times, and that will be the case in the future as well. So if you are somebody that's been newer, and let's say you just got tempted into the stock market here within the last year or so when conditions were rosy, and now you're feeling like your head's been cut off, survive. You need to survive in order to thrive down the road. Do everything you can to learn from these experiences, and you'll be all the better off later on. Just like you're learning from me now, hopefully, in my experiences over the last 20 years, and just like I learned from my boss back when I was a young 20-something, and he was trading during the 1987 wipeout, right? We all learn from not only the experiences that we have, but hopefully you're also learning from other people's experiences that have been through these types of wipeouts in the past. So keep up the good work. I know it's hard to, accept a message like that on a day like this, but do your best to learn. And yes, today is painful, but there will be better times in front of us. All right, so with that message out of the way, let's go ahead and take a look at our traditional 4 grid here. And this is chart 4B for those of you that are following along at home. And as you can see, we do have strongly bearish postures across the board. Now, interestingly enough, I didn't actually look at this yesterday myself since David did the video yesterday, but I do see that because of yesterday's big rally, it kind of did one of those head fake situations where it quickly changed the posture back to weakly bullish. Remember, it was not strongly bullish. You have that light green color there on the S&P 500 and also on the Dow Jones. And now, of course, we're right back to strongly bearish posture with that darker color of pink on both of those. But down below on the Nasdaq Composite and the Russell 2000, both of those stayed with a strongly bearish posture despite yesterday's epic rip to the upside on both of them. So that's how bearish things have been, that even, a 3 or 4% up move type of a day like we saw yesterday was not enough to even budge the posture on the Nasdaq Composite and the Russell 2000. And, in this case, it shows that the indicator knew what it was doing. Whether it was predicting that the very next day there would be a wipeout like we saw today, it can be debated. But it is a reminder that, these indicators are not perfect. There is no perfect technical indicator out there, but what it's trying to do is keep you on the right side of the market from an intermediate time perspective. And I think it did a pretty good job in the face of an extreme circumstance when it comes to the Nasdaq and the Russell 2000. Let's go through the numbers here today. The S&P 500, as I mentioned before, was down 3.56%. So, as you can see, that led to a circumstance where the green line was just barely above the upper reversal zone after yesterday's rally, but now pushed it back into the lower reversal zone. Sorry if I misstated that a second ago. So it was just barely above the lower reversal zone yesterday, right? So the green line went from something like, 15 up to like 21 yesterday. So 21 is above 20, and that lower reversal zone is at 20. So therefore, that's why that background color went to light green for just one single day. But then one day later, that wipeout pushes that green line back into the lower reversal zone once again. And so that's why we're back to that strongly bearish posture. Now remember, if we get some sort of an epic move to the upside tomorrow, there's a pretty decent chance that that green line is so close to that lower reversal zone right now that it could easily get back to a bullish posture as soon as tomorrow. Whether that's in the cards or not is anybody's guess. Obviously, we've had very volatile trading here recently, so anything is possible. Remember, tomorrow actually is an important economic release date as well, as the first Friday of every new month is the jobs numbers, and so that has the possibility of making an impact on the market. So, buckle up. This has been a volatile week, and it could very well end in volatile fashion tomorrow as well. But right now, we are back to that strongly bearish posture, just like we have been for much of the last 2 weeks, with the exception of yesterday being kind of a head fake due to the extreme up move that the markets had. But even with that extreme up move, some of you probably would have been hesitant to get too bullish on the markets yesterday, even if you recognize that there was a change in the color on the chart. And the reason I say that is the change on the color did not go to dark green. It just went to light green, meaning that we had a weakly bullish posture, not a strongly bullish posture. In addition to that, we were still well below a falling 30-day moving average, right? This color of the moving average did not budge despite yesterday's immense move higher. So the path of least resistance continues to be to the downside according to what we interpret from the 30-day moving average itself. With the Dow Jones Industrial Average, it fared a little bit better than all of the other indices today. And again, hopefully that's something you guys have learned from David and I over time. That is what you would anticipate. When you have a massive wipeout day like we saw today, then it is the blue chip Dow index that tends to hold up a little bit better. And it did. It was still down tremendously, but it was down only 3.12%, and that was better than all of the other indices because, again, you got stocks like Coca-Cola and Procter & Gamble and those types of companies that certainly were down today, but weren't down nearly as violently as something like Tesla, which is not in the Dow Jones Industrial Average. So we are back to that strongly bearish posture using the Dow Jones Industrial Average, and it's really the same commentary as what I just got done mentioning with the S&P 500. Yes, you had a weekly bullish posture for one day yesterday, but I don't think a lot of you would have been tricked into that move there, at least from a short-term perspective, because we still had a weekly bullish posture, not strongly bullish, and we still had a red moving average that entire time. So price was below a falling 30-day moving average. Price of least resistance continued to be to the downside. Same thing on the S&P 500 is here on the Dow Jones, which is this one could easily get back into a different posture as soon as tomorrow if we have a big update. Let's talk about the bottom two charts now. And as you can see, we've got an additional label showing up here on the Nasdaq Composite chart. You'll notice there's a pink label here that says yearly low today. So that is a little bit different there because today, as you can see, we have our low tag underneath today's candle. Whereas if you look at the S&P 500, that low tag was here on May 2nd. And remember, these are only 6-month charts, so it is always possible that you had a low, let's say 7 months ago, and you still might not have the yearly low tag because this is looking back a full 12 months. But anyway, usually more times than not, you'll see it here within the most recent 6 months. And in that case, the S&P 500 hit its low on May 2nd, and then the Russell 2000 also hit its low on May 2nd. But today, the Nasdaq once again is showing that there is tremendous pressure in those technology-oriented stocks. It is the worst performer at this moment in time. And you can discover that in a few different ways. It is this market's current laggard. First of all, I would point out that it did not go up to a weekly bullish posture yesterday like we saw with the S&P 500 and the Dow Jones Industrial Average. So we know right there that it is a laggard compared to those two from that one instance. We also know that it's a laggard compared to all of the other charts right now because of where its intermediate reading is. Notice in the label that its intermediate reading is at 13. That's lower than all of the other indices that are out there. In other words, there's been more heavy selling pressure where you're pushing the index closer to its trading low ranges compared to the other indices at this moment in time. But in addition to that, this is the only one out of these 4 major U.S. equity indices that hit a new yearly low today. Right? It is leading to the downside, or it is the biggest loser or the biggest laggard, however you want to describe that. But it is the Nasdaq that is having the biggest struggles right now, as this market doesn't want to have anything to do with growth stocks, and it wants to hunker down where it can in what it perceives to be safer types of businesses that are outside of the traditional technology, communications, and consumer discretionary areas. So not a good day at all for the Nasdaq. Basically a 5% wipeout in a single session, completely eliminating all the gains that you saw yesterday and hitting a new yearly low in the process. Let's talk about the Russell 2000 now. It was down a big chunk as well. It was down 4.04%. So that made it the second worst performer here today after the Nasdaq Composite. And it didn't quite hit a new yearly low, but it got awfully close. You can see that the long shadow here underneath today's candle nearly ticked that low. it wouldn't have had to go very much further. We caught a little bit of a bid at the end of the day, and when I say the end of the day, I mean the literal end of the day. It was like 10 minutes to go in the session, and we caught a little burst of bullish energy. But before that, it was like 10 minutes before the bell closed, we were at session lows. So the final 10 minutes of the day were bullish, and that actually worked out quite nicely for my trade application example today. We'll talk about that later in the video, but it was right around that time that I got my put sale to go through, and so we were actually up a very nice chunk in percentage terms on that put sale that I did, simply because the markets did rally in that final 10 minutes of the session, which was basically immediately after I sold my put. It was just sheer luck, but it is what it is. Sometimes you get lucky that way. So there was a little bit of a rally at the end of the day, and I think that is, somewhat beneficial, and hopefully means that there are some bulls out there, and that it's not going to be just a complete wipeout as we start tomorrow's session. There might even be some people nibbling on opportunities where some stocks probably got a little too unfairly punished with today's wipeout that we experienced. But similar to the Nasdaq Composite, the Russell 2000 did not go to a weekly bullish posture yesterday. It stayed strongly bearish this entire time despite that 3-day rally, and it continues to trade below a falling 30-day moving average. And so the path of least resistance on all of these charts remains to the downside. Not fun to deliver that message, but don't kill the messenger, right? I'm just reading the technical indicator. If I had it my way, I wish the markets would behave themselves, right? I certainly am at a disadvantage on days when the markets get wiped out like they were here today. So I'm feeling the pain right alongside of all of y'all, but it is true that reading the charts is meant to help you understand what's taking place in the here and the now, and right now it is more bears controlling the price action than bulls. Let's go ahead and step away from the platform for a second. I always like to get a chance to say thank you to those of you that help support these free presentations. As I like to remind you guys regularly, it takes at least 3 hours of David and I's time to do these presentations where we don't make a single cent from doing them, right? We don't have advertisers, or we don't charge you to watch these videos or anything along those lines. So you can imagine that as busy business owners, we have to justify the amount of time we spend on any typical projects, and therefore we ask one simple request out of you guys to help us justify the time that goes into these videos if you find them helpful. Obviously, if you don't find them helpful, you don't need to help support us, because it won't matter to you if we stop doing these videos in the future. But if you do want these videos to continue, do your best to help support us. And the one thing that we ask you to do is help support us there on social media. You guys have done an amazing job for me, and I really appreciate that. When I did the video on Tuesday, you can see that 103 of you clicked like for me there. And anytime we're in the triple digits, as I always tell you, I'll plan on doing a full-length video the next time I'm scheduled to do the video, which is why I'm doing it right now. We're already 36 minutes into this video here tonight, and the video would have already been over had we not gotten those extra 3 likers there. Had we ended up at, let's say, 99 likes, this video would already be over, because it would have only been a 15-minute quick snapshot with no trade application example. And I've got to believe that when conditions are as volatile as they are here recently, you guys would prefer to see more content and not less. So do your best. I know for some of you, you view it as a huge chore to click like for us on Twitter, and I'm just teasing you there, but obviously it shouldn't be that big of a deal. It should take you less than 5 seconds to do it. So thank you to all my pals out there, all my friends who are willing to click like for us. So thank you to Valerie, thank you to Ron and HR and Tom and Dave and Dennis and Fun Jonesy and Odin and Michael and Jeff and Stock Market Junkie and Jayesh and Catherine and Ram and Teddy and Evan and Margie and Gerald and Dale and Roger. There's too many to go through. There's Phil. Got a chance to meet up with Phil at the Berkshire Hathaway event last week, so hope you enjoyed your ride back home in your vet. There's Richie Rich and Paul and Surendhar. Like to see all of your guys' names there, so thank you very much. And I do recognize when your notifications come in. You guys are hugely supportive. perspective, and you're the reason why we're still in this video right now. So keep it up on your end. If you want these free videos to come to you 5 times a week traditionally, then do your part to help support them. And so that way David and I can justify the time we spend on putting them together. While we're over here, let's also talk about the Sector Selector tool. I didn't bring this up in Tuesday's video, so we'll just briefly review it now. Remember, I will update this again tomorrow night. So this is a couple of days stale at this point, but at least gives us a general idea of what's happening from a sector rotation perspective. And as you can see, once again, this market is still being led by energy stocks, in other words, oil and gas companies. You also had consumer staples make their way up into the second place position. You have utilities in the third place position, and then materials in the fourth place position. And like I pointed out a few weeks back when those 4 were the top 4, remember, those are basically your top 4 up here when we're kind of talking about the traditional sector rotation model, when we're kind of going into more of a contraction type of a period in the economy, where you find materials and energy doing well because of high inflation with commodity prices, and then you also see consumer staples and utilities doing well because the market is not willing to take on risk in the growth companies any longer, and they want to hunker down in the defensive companies and just kind of take cover from the bombing that is taking place by the market at large. So once again, this is not a good look from a broad markets perspective of what we see leading the way with the Sector Selector. And you do have some of those important areas like consumer discretionary, information technology, and communication services controlling 3 out of the bottom 4 positions there. And again, those are the ones you would prefer to see up at the top, because those are the ones that can have some of the best bullish trends out there when things are really clicking. So to see the ones that we prefer at the top at the bottom, and the ones that we prefer at the bottom at the top, we're kind of in that opposite world, as George Costanza would say, and this is not what we want to see if we want to be bullish within the markets right now. Also on the Factor Selector now, remember, we reviewed this tool a little bit more in my Wednesday morning class, whereas the Sector Selector we review in my Monday morning class. But this gives us another way to slice and dice the markets to help us understand what's taking place at any moment of time. And you can see once again, dividend yield is back up at the top. Remember, dividend yield had been at the top of the Factor Selector for several months back here during that February-March time period, and then it's kind of been going back and forth from number 1 and number 2 in the past month or so. And the reason that they're benefiting right now is because they control kind of that blue chip activity. Coca-Cola, Procter & Gamble, Hershey's, those types of companies that most people would feel are quite boring. I myself am quite happy with those companies, but I have a different interest in the markets than many of you perhaps as a longer term investor. Nonetheless, what it does tell us here in the short term is that this is a market that is scared. It doesn't want to be in the Teslas right now. It doesn't want to be in the Nvidias right now. It's scared of those, even though in many ways some of those other businesses are superior businesses, but the market doesn't care. It wants to hunker down in boring Hershey's and boring Coca-Cola and boring Procter & Gamble right now. And that's why you're seeing the dividend yield category benefit from a factor perspective. Now, many of those dividend yielding companies are down recently. It's just that they are still outperforming on a relative basis, where you're seeing the momentum category really getting wiped out. That's where you're going to find a lot of your growth types of stocks, your Momo types of stocks are getting annihilated right now. And so, that has a chance to change as those portfolios kind of change their stripes over time. But right now, they have not benefited at all from this market's aversion to risk. So once again, momentum on the bottom, dividend yield on the top. I'll say the same thing on the Factor Selector as what I just said on the Sector Selector. In an ideal world, you want those two to be exactly flip-flopped. You want momentum at the top and dividend yield at the bottom. You want the boring stocks to not collect any interest from the market, and you want the wild momentum growth stocks to be, urging investors on into risk-taking, and that is the opposite of what we have at this moment in time. I also taught my my question and answer session earlier today. Some of you might be aware that we're having some uploading issues with our class files going to YouTube. It's strange because these market outlook videos that we record on Camtasia are being uploaded properly to YouTube, but for some reason the file conversion that we use for our classes is not working. And so be aware that I do have some additional instructions for those of you that click into my question and answer session video, where you'll have to watch the WebEx version of the recording, not the YouTube version for the time being. So we've got our feelers out and we're trying to figure out how to resolve that issue, but it just started hitting this week, so it's a little bit new to us as well. But in the meantime, you can still watch the WebEx versions of the videos, which you'll find, remember, down below here in that website area when you click into the classes on our calendar. And this is specifically for our premium members at Market Scholar. So if you're just somebody that watches these free YouTube videos, unfortunately you would not be privy to this. But for those of you that are our premium members, here are some of the discussions we had today in case it catches your interest and you want to hear my insight on it. I got a question about reviewing Stanley Black & Decker's business model as a dividend growth investing candidate. I got a question about whether we should consider changing our philosophy of dividend growth investing based upon the ever-rising interest rates and inflation out there, and how we are actually doing that already, whether people recognize it or not. And so I kind of explained my philosophy there. I also got a question about how does Warren Buffett feel about other FANG stocks that are not Apple? So, for instance, Amazon and Meta and Google and Netflix, as I'm somebody who's been back to the last 16 Berkshire Hathaway meetings, dating back to every meeting since 2005 that was at least held in person, that they allowed an audience in. Of course, I didn't get a chance to go the last 2 years because of COVID, when they didn't have an audience. But other than that, I've been to every Berkshire Hathaway meeting since the year 2005. And so I got a pretty good feel as to how Warren Buffett and Charlie Munger think, and whether they would ever take an interest in those types of companies. And so the answer to that might surprise you. If you're interested in my answer, feel free to watch the recording. I got another question about going over the dividend stair-step chart. So this is kind of what I had referenced earlier in the presentation tonight. You can see here that I spent the time from 1 hour and 23 minute mark all the way to the 2 hour and 52 minute mark. So it was basically an hour and 20 minutes. I went over every single detail that I could think of on the dividend stair-step chart to help you guys know how to interpret that chart a little bit better when you're using it for your own dividend analysis. I got another question about what my opinion was as to why the financial sector stocks are at a good value right now, and why have they been falling here more recently. And so if you're interested in my discussion about the yield curve and the 10s and 2s spread, feel free and check out that part of the recording. I also got a question about what to do if you receive papers in the mail about lawsuit class actions on stocks that you might have owned in the past. I also got a question about reviewing Goldman Sachs as a possible dividend growth investment where you could possibly add to it. And then I got a question about the sector selector and where to find some files from historical graphics there. So if you have an interest in any of those topics, feel free and go back and watch that recording if you are a premium member. And of course, that is not a hard sale to you, but that is a soft sale to those of you who are not premium members. This is just a glance at a very minor part of all the benefits you get as a premium member, including access, real-time access to our trade alerts that I had mentioned earlier today as well. So for those of you that have been watching us for free on these YouTube videos over the years, the hope that David and I have is that some of you will convert eventually into premium members and you'll take your education to the next level. And of course, we'd love to have you. So I hope you do consider that at some point. Let's get back on track with some more analysis on the charts now. And let's do some 12 grid analysis, starting with chart 5A. This is our asset class 12 grid, and a reminder that the background colors of these charts will be either pink or green, depending upon whether the current intermediate posture on the market forecast is bullish or bearish. So as you can see, with this first set of 12 grids, we have just 3 bullish charts on the board, and they all happen to be on the bottom rung. And for those of you that have been watching me go through this 12 grid with you pretty much 2 times a week for the last several months, this should not come as a surprise to you because it's more of the same. It's like a broken record. If we've had any bullishness from an asset class perspective, in recent weeks and months, it has typically come from that bottom rung, and that continues to be the case. As you can see, the three green charts on the board not only have a bullish intermediate posture, but all three of them were actually up today. So let's go through those first, and then we'll get into some of the uglier charts that are out there. So let's start with the US dollar in the lower left-hand corner here. And you can see, once again, the US dollar firmed up. It was up 0.84% on a day when the stock market got annihilated. So I guess the good news is, if you've got a trip to Europe planned in the future, perhaps your dollar will stretch a little bit further than it would have prior to this big move. Now the dollar, truth be told, has largely been going sideways for the last week. The real move was made during this period right here. This was amazing, where the dollar went up 6 days in a row without hardly any selling pressure whatsoever. Remember that the dollar benefits from the idea of it's the best house in a bad neighborhood. What I mean by that is all currencies, to a degree, kind of get inflated because the printing presses are going off 24/7 all around the world, regardless of what your central bank is, right? Some of you watch this video from other place other than the United States, and hello to all of you foreign watchers as well. We're grateful to have you in our audience. But the vast majority of our audience, of course, resides here in the United States, where David and I do as well. And so it is kind of interesting that the US dollar benefits, even though the Fed has been highly dovish in recent years. Now that is changing, of course, yesterday being one of those reminders of that, where we are now starting to go into an era of quantitative tightening instead of quantitative easing, and therefore that can somewhat benefit the dollar as well. Remember that there are plenty of times throughout history where the US dollar reacts to what's happening with Treasury yields, and that's effectively what's happening right now. If you think about it, you know, we all have an opportunity to invest our money somewhere. And investors all around the globe are making that decision every single day. Now, a lot of us have a home country bias. And for those of you that aren't aware, if you have been investing in the stock market in the United States for the last 20 years, it has been a blessing that you've had a home country bias, because we have had spectacular performance versus most other country indices around the world. But that won't always be the case in the future. But that same mindset where somebody has to make that decision of what country they want to invest in the stock market, they also have to make that decision in the bond market and in currency markets and other types of markets as well. And what you'll find is that if the Treasury yields are going up, it is effectively a way of trying to entice folks to invest in the bond market. And that doesn't include just us here in the United States. Because we offer the deepest, most liquid financial markets on planet Earth here in the good old US of A, there are plenty of foreign buyers of our financial assets. And so if there's a foreign buyer or a potential foreign buyer, let's say residing in, how about Germany right now? And they're making the decision of whether to buy U.S. government bonds or Japanese government bonds. All else being equal, they might prefer the U.S. government bonds simply because we have much higher interest rates here in the United States than they do over in Japan. So all else being equal, if you think that both the Japanese government and the US government are good for their money and will, give that German investor all their money back upon maturity, then the difference maker, besides currency, is what is the interest rate that you're going to receive for allowing another government to borrow your money. And since you're going to receive a higher reward by allowing the US government to borrow the money, then that German investor might be more interested in investing in the United States government bond market. Well, remember, when that German investor who currently resides in Germany and likely does a lot of business using euros, when they start doing business in the United States, they're going to need to convert their euros into US dollars. And their motivation is to get US dollars to buy US treasuries. So you can see how that all kind of works together, because now you've got this pressure on the US dollar from outside foreign buyers that need to convert their currencies into US dollars. So that's creating demand for US dollars for the purpose of being able to invest in US financial assets. So we are in that kind of a mode right now where both of those are doing well at the exact same time. And they're both in just epic uptrends right now. We talked a lot about the 10-year Treasury yield, by the way, in my question and answer session today. That was the common theme that was strung throughout all of the questions today. So again, if you're a premium member, feel free to watch the recording to get my insight on that. But we have had an epic move on the Treasury yields here. We are now well above 3%. That's really only happened 2 other times throughout the last decade where we've been kind of stranded at this 3% yield level, and we really didn't get much progress beyond that. So who knows, maybe we're about due for a little bit of relief around that topic, as the markets in the past haven't really been willing to go much beyond 3%. Then again, this is a little bit of a different type of a market as well, where we've got the Fed effectively saying we want interest rates to go lower in order to squash inflation, and that really wasn't the case as much in the 2 other times throughout history where we were at a 3% yield. So who knows, maybe we can stretch this up to a 4% or a 5% level. And if we do, watch out. Those growth stocks that are getting crushed right now at a 3% yield could be in, just a epic meltdown type of a mode if interest rates keep on chugging higher in the years to come. So it's going to be really interesting to witness. That is for sure. Oil was up today as well. It was up 0.32%. So not a huge day for oil, but the fact that it was up on a day when most financial assets were getting destroyed does go to show you trends are strong in that particular area of the world. So that particular commodity has continued to garner strength despite a lot of naysayers out there, a lot of people that just absolutely refuse to invest in oil or oil stocks. Some of them perhaps for good reasons, others perhaps not as good of reasons. But I'm not here to judge. I'm just here to tell you what's going on. And if you've refused to invest in oil or oil and gas stocks in the past, you probably are doing a little bit worse for yourself at this exact moment in time than folks that do have a healthy chunk of their portfolio in those types of assets. So oil continues to be a pretty strong performer. Gold, on the other hand, has been a disappointment. This chart on the bottom rung, that is in pink, is gold, and it was down 0.38% today. A lot of times when you have a chaotic day like this, gold can act as a bastion of safety. Today, that was not the case. You had a sell-off day in gold, and you remain below a falling 30-day moving average there. So it doesn't look too good with gold. Yes, you had that oversold cluster signal there that might lead to a quick little dead cat type of a bounce, but that doesn't mean that it's going to be a trend changing type of a bounce. So I think you got to be a little bit more careful with gold at these levels, judging by what's happening on the charts here more recently. All the rest of the charts are ugly, ugly, ugly. I probably don't need to belabor the point, but foreign developed stocks were down 3.22% today. Foreign emerging stocks were down 3.69% today. Remember that brief bullish posture that happened on EEM a couple days ago? Yeah, that's gone. So it's ugly out there. And Bitcoin got wiped out today as well. Bitcoin was down 8%. I'm sure a lot of people are probably blaming Warren Buffett and Charlie Munger for that with all their negative commentary around Bitcoin. And of course, I'm just joking there, going back to what I'd mentioned before. Why the world cares what a couple of 90-year-olds think about a cryptocurrency is beyond me. But it is what it is. It is a risk asset, right? How many times have we stated that? If you are going to find that the Nasdaq and growth stocks are going to get wiped out, chances are that Bitcoin is going to struggle in that environment as well. Vice versa can also be true. So we'll keep our eye on it, and if it ever does turn around, we'll be the first to let you know about that. Let's also take a look here at our Sector 12 grid. And as you can see, we only have 2 green charts on the board. The first one is energy. It was down today, but it was the best performing, or not the best performing. I'm looking at utilities now, only down 1.02%. But energy was actually the second best performer today, only down 1.5%. Most of these other sectors were down 2, 3, 4, 5%, that sort of a thing. So the fact that energy held up on a day like today and did not give back many of its gains is rather impressive. You actually had a long lower shadow on energy here today that was more aggressive than what you found on a lot of other candles as well. So this remains your champion in this market, just like we saw just a little bit ago when I was reviewing the sector selector information with you. There is a reason why energy has dominated the #1 position for well more than 3 months in a row without budging off the top whatsoever. All you have to do is look at this chart in comparison to everything else on the board, and it shouldn't be too hard to figure that out. Industrials is kind of a sneaky weakly bullish posture, but not a strongly bullish posture yet. So there was enough burst of energy yesterday that despite today's give back, you still have that weakly bullish posture. And you can see the reason behind that. Compare that to discretionary just to the left a little bit here. Discretionary hit a multi-month low here the day after a huge burst higher. Now compare that to industrials that also had a huge burst higher yesterday and also sold off pretty sharply today, but did not give up all of its gains. The 2-day return on industrials is still positive, and that is not the case with most other sectors that are out there. So it's a house of pain for the vast majority of other charts out there. Right now, the only sector that is trading above its 30-day moving average is energy. That's it. Not another single sector is. Staples are pretty close, but it is still slightly below it at this exact moment in time. Today, of course, it's no surprise that consumer discretionary was your worst participant, down 5.6%. Of course, that stems directly from what I showed you on the heat map with Tesla and Amazon getting completely annihilated here today. But it wasn't fun in tech land either. Technology was down 4.8%. Now that's a good segue to the trade application example. And before I get to it, actually I'll pull it up first. So let me pull up chart 2A, and then I'm going to pull up the Qs. QQQ. Some of you should be familiar with that ticker symbol. It's one of the most popular ETFs on planet Earth, and it tracks the Nasdaq 100. Remember, it's a little bit different than the Nasdaq Composite that we talk about in our foregrid, but a lot of times they are somewhat similar to one another. So these are the 100 biggest non-financial companies in the Nasdaq Composite that comprise the QQQ. And this stems from a comment I made on Twitter just yesterday before the Jerome Powell increase in the market. This was in the morning yesterday. So this is, again, before Jerome Powell made the interest rate decision. Remember, yesterday in the morning before the meeting, the market was getting hit pretty hard. And I pointed out on Twitter, so again, this is part of the reason you guys should follow both David and myself on Twitter, because we're trying to lend our insight to you throughout the day, even between our classes. And yesterday I said, we currently have an oversold cluster signal using weekly candles on QQQ. The week is not done yet, and this could change by Friday's close, so it is important to remember that, and that's still the case now. If we have a massive move up tomorrow, that cluster could go away, so that it's not locked in until the week is done, so we'll find out all tomorrow afternoon. But I say if it stays, it would be just the second time with an oversold weekly candle cluster over the past 10 years, so the entire last decade, that we've had that signal. The only other one called the lows during the 2018 Christmas swoon. And then I show you this graph right here, and if you click on it, you can kind of expand into it a bit more, and you can see what I was referencing there yesterday afternoon. This little green dot on the chart up above here for QQQ is showing up because we had the green, the blue, and the red lines on the market forecast all in the lower reversal zone on the same weekly candle. So that little green dot down below corresponds with this green dot up above. And you can see here that the only other time we had that in the last decade was back here where I point out with this other arrow, and this was during that Christmas swoon of 2018 where we had the same thing. We had a green dot show up down below here because the green, the blue, and the red lines were all in the low reversal zone at the same day, and that corresponded with that green dot up here. In other words, it's an oversold condition. Now in this case, it actually ended up being a trend-changing reversal. I do not personally expect that this time around, but I do think that there's a decent chance for a bullish rally in the short term. So again, I'm not expecting to be at new highs by the end of the summer or something along those lines. I think this is a much more aggressive sell-off, way below the moving average than what we experienced here. This was a lot easier to make up from. This is going to be much more difficult, and so I'm just not counting on that. If it happens, great, but if it's not what my expectations are right now. Nonetheless, I do think that there can be a chance for some sort of a bullish bounce back here in the next week or two as a result of these extreme oversold conditions. Now, what was interesting about it is after yesterday's epic rally, after Jerome Powell made the interest rate decision, that dot went away, and so I was like thinking to myself, boy, I'm glad I put that on Twitter, so I have actually the evidence to show that it did exist at one time. But of course, here we are one day later, and with the epic sell-off once again here today, we once again do have that little green dot showing up right here. Now, this is a clean chart, so it doesn't actually show the market forecast on there. It just shows the dots themselves. But I wanted to pull this up to kind of show you that over the last 10 years, pulling up QQQ using chart 2A, the green dot that we have under the current candle that will officially lock in place tomorrow. So it could, again, that green dot could go away if there's a big up day tomorrow, but if it's a down day tomorrow, that green dot will likely stay. And the only other time before this week, out of all the weeks, right, there's 52 weeks in a year, but we're talking about 520 weeks here, right, because this is a 10-year chart. So out of the prior 520 weeks before this week, that had only happened on QQQ one other time, right here, the Christmas week of 2018. And then we, of course, had a bullish rally immediately after that. So what I chose to do with tonight's trade application example is yet again another sold put trade. And I'm sure you're not surprised to hear that because I've been doing a lot of those. You guys know my MO. I like selling puts on days when the market is down more than 1%. And of course, with the market down in this case 5% today for the Nasdaq Composite or the Nasdaq 100, then I have even extra incentive to do that because of course volatility is higher, and I prefer to sell puts when volatility is higher. So that way I get the benefit of when volatility comes back in, I get that volatility compression benefit within the options pricing model. So I did that here today. And as I mentioned earlier, I actually sold the put with only about 10 minutes left in the market. It felt like it was a trending lower type of a day, so I wanted to wait until later in the day to try to get filled. And wouldn't you know that pretty much immediately after I sold the put, the market did have a 10-minute rally into the close. So we got a pretty fortunate fill on that particular trade. But remember, that's why I telegram you guys immediately when I get the trades done. So that way, those of you that are premium members of Market Scholars can, if you want to, follow along. Obviously, that's not a recommendation as I'm not your licensed financial broker or anything like that. But if you want to at least examine the trades that David and I are doing, you have that opportunity to look at that on the telegram. And in today's case, had you done it exactly when I placed the trade, you'd have a few bucks of profits so far as we had that nice little bounce at the end of the day. For those of you that aren't aware, the Nasdaq was actually down 6% at the worst point, 10 minutes to go, and then it rallied almost an entire 100 basis points the final 10 minutes and still closed down by 5%, which is an epic wipeout, but it could have easily been a 6% wipeout day if it wasn't for that final 10 minutes of the day. So what I did was I sold the June $260 puts, and I got filled at $2.80, which was pretty close to the best fill of the day. The best fill I checked was actually $2.90, so I was just 10 cents away from getting the best fill of the day, but we're up there in that territory, and I was happy to see it. So anyway, what that means for us, for those of you that are less familiar with the idea of selling puts, is we are now on the hook for buying 100 shares of QQQ if QQQ goes from a current price of $313 down to $260 between now and the middle of June. So that's like, 40 some trading days from right now. So if we continue to have an epic slide, there is a decent chance that that could be in that general vicinity. But if you believe, as I do, that with this unique circumstance of us having an oversold weekly candle cluster on QQQ right now that's happened only for the second time in the last 520 weeks, that we are due for a little bit of a rally, then it's entirely possible that we rally, let's say, next week or the week after that. And even if we roll over again, which I think is a pretty high likelihood, it's going to give us kind of that built-in benefit where it's not going straight down to 260. You get a little bounce up, maybe we even get up closer to like 340, and then it rolls over again, but by then the put will likely have been expired. So that's what I'm hoping for. We'll see how it goes. It's a little bit of a different trade here because normally I'm selling puts on individual stocks that I want to own for the long term because I like where their dividend yield is. This is a little bit different where I'm selling a put on a kind of a broad-based index product where I don't really care about the dividend per se, but I am reacting to what I'm recognizing here with this oversold cluster signal. And it is a situation where if it were to roll down to 260, there's a pretty decent chance that I would likely start rolling that trade as well. So if that does come to it, again, I don't know if that'll happen. Hopefully it doesn't. But if it does come to it, for those of you that are premium members, remember we continue to manage these trades after we place them. And so if I do start rolling the 260 down to the 250 or the 240 or something along those lines a few weeks from right now, I'll let you guys know in the Telegram Trade Alerts app that we use for our premium members there as well. Okay, so that's what I had for you here today. It was a monumental day. It was a historic day, particularly in consideration to what we experienced yesterday. So today's video is a little bit longer than normal to make sure that we got through everything and make sure you guys are all on the up and up with what today's action means for you moving forward as well. Remember, tomorrow's an important day because of the jobs number, so I'm sure David will have a really good presentation for you guys this weekend to wrap things up there as well. But if you got value out of my presentation tonight, as always, I ask one simple thing out of you. Click like for me on Twitter. It only takes 5 seconds of your time, and it doesn't cost you a single penny. And so if you're willing to do that for us, and at least 100 of you can do that for me, by the time I'm scheduled to do the video again on Tuesday, I'll plan on doing another full-length video for you at that time with a trade application example like the one I just showed you here. If less than 100 people are willing to take that basic effort of 5 seconds out of their day for us, then you can imagine that I'll just end up doing a shortened video with no trade application example. So I'll let you guys decide that collectively, but put your hard hat on for tomorrow. It could be another rocky session. Enjoy perhaps an adult beverage tonight, celebrate your Cinco de Mayo, but we've got one more day to survive this week and then really relax over the weekend. So until next time, I want to wish you all the best of success with your trades and your investments. Goodbye for now.